You said coming back in force. Well, optimism has surely been coming back in force to this market. The S&P 500 up in 9 of 10 of the last weeks. And to give you a sense of the tone, take a look right here. This is the Bank of America Merrill Lynch Global Financial Stress Indicator. As you can see, lowest level since May. And the way you read this is that if it's above zero, that means financial stress is above where it normally is. If it's below zero, it's below where financial stress usually is across global markets. Well, clearly now it is well below zero. So now investors are saying market laggards should really be playing a game of catch-up here. So one area of the market that could play a game of catch-up would be emerging markets. Over the past decade, it's really been the TINA world. There is no alternative, and that being the U.S. But as you can see right here, if you look at the relative performance ratio of the MSCI Emerging Markets Index versus the S&P 500, it hit a 16-year low. That's where we are now. Now you have the likes of Edward Jones overweighting emerging markets. At the same time, BlackRock is advising their investors to get exposure to cyclical assets. That also includes emerging markets. Another area that we could see do some mean reversion, also get an uptick as we see laggards start to outperform. Well, that would be value. We've seen many head fakes over the past decade. However, many are questioning if this time is actually different. One indicator they are looking at is the yield curve. If you look at the spread between the 3-month yield and 10-year treasury yields, as you can see, moving higher. We've gotten a steepening recently after an inversion earlier in the year. The two have been roughly related. So now some investment shops out there are saying this could be different if we truly do see the yield curve steepening and that signaling a brighter economic outlook.